This shifting jobs picture is just one of the changes in the markets that has led our next guest to downgrade his view on equities. Joining us now is Warren Pies from 314 Research. So, Warren, it's great to have you. I know you've been kind of on this idea that AI-exposed jobs have performed worse than other types of jobs. So do you think that's kind of filtering into the way the market's assessing the macro outlook?
Oh, most definitely. I think we're at a turning point right now, and it's always difficult at turning points, and there's always a disparity of opinions in how you interpret the data, and you almost by definition have to be a little bit creative with how you do your work. So what we did is we split out the BLS data, and we categorized the 30 most, in our view, AI exposed industries, and we compared them to the 30 most AI resistant industries, and then we looked at the trends within those, the job creation within those industries, and then compared it to their pre-COVID trend line. We stripped out 2020 and 2021 because there was a lot of overhiring in these tech-exposed places, industries back then. And I think the message is nascent but clear that AI is starting to have an impact. I think the first phase of this was a lowering of hiring rates. In the second phase, and we're seeing that in some of these anecdotes, and I wouldn't ignore anecdotes entirely. You want to have data to back it up, but the anecdotes are pointing towards the next phase, which is going to be some sporadic layoffs. And so, yes, I think it's absolutely a big deal. I think it's showing up in, obviously, in the equity prices of the software industry. We're seeing that. Malcolm talked about that, but we're seeing it now in the rates market. So if you're really pushing against this and saying this is all AI psychosis, you should be arguing with the SOFR market. So overnight rates market is slowly pushing more cuts into this cycle and expanding them out into 2027. And that ultimately drags the 10-year down like we're seeing. So when we downgraded stocks a few weeks ago, we upgraded bonds, and this was really the big reason.
So if you draw those inferences from what the market is doing right now, what does that otherwise mean for the economy and stocks? Can we still have this kind of GDP grows okay, jobs suffer type of a dynamic? And how does AI get kind of interpreted as an influence on equity sector activity?
Yeah, that's going to be the $64,000 question going forward. There's some doomsday scenarios you could create where we're just going to have rapid adoption and diffusion of AI technology into the economy, and it's just net job losses and a depression. And, that's not our base case. I don't think that's going to happen. I think it's best looked at as a modest headwind to the labor market going forward. And so when we came into the year, we saw cyclical support to the disinflation story. We saw oil prices staying contained. We thought there was cyclical problems in the labor market. We saw that in residential construction jobs and things like that. And housing inflation as well, we thought was starting to move lower almost mechanically. So now you throw this AI story and you're hollowing out of maybe some of the white collar jobs and slowing down hiring there and replacing it instead with AI investment. I think that's another headwind to the inflation story. So as long as it doesn't pick up steam and then cause defaults and things like that, or the defaults that happen are contained, then I think this is actually not a bad macro backdrop going forward. And I do think productivity increases. We're seeing it in our business. This technology is transformational. And that's part of, like, anyone who touches it in reality in their business feels the power, and then they can extrapolate out. And I think the market is having this aha moment all at once.
How do you think about the credit risks out there, Warren? I mean, we're in an environment where, as you outlined, yields are pushing lower, credit spreads are widening, so it's pointing to some distress there. But you said perhaps it could remain contained. Is that your base case?
Yeah, that is my base case. I mean, one of the things we did this today was we started looking at the high yield index because, like you said, we're seeing spreads widen. It's not entirely anomalous to see spreads widen when yields have a sudden pullback like this. But what we did is we started looking at an ex-tech analysis of high yield market, and really spreads have the blowout in spreads is mostly contained to some financials and tech. Now, that's a big part of the economy, and I don't know how much of a comfort that is. But for now, the blowout in spreads is tech contained. I still think that's my base case. I think that some of the moves in the market are a little overdone. Software stocks were overvalued coming into this. I don't see them as like a deal here, but we've corrected the overvaluation at least. And honestly, I think this is all part of the process of correcting. And like Mike said, it's actually showing some signs of strength. The fact that we've stayed in this range and worked sentiment off so effectively in this range. I think that when you break out, it's probably going to be the upside and it's going to be bullish. And I ultimately think tech's going to lead. So, yeah, there's choppiness. I think it'll be contained. But overall, I don't think it spills over and hurts the broader economy.